Despite a decade of proof points, European pensions still allocate only marginally to European venture, not because of returns, but because of structure and coordination. Professor Philippe Tibi has worked inside that gap, pushing Europe's largest institutions to move. Today, he lays out why LP fragmentation is now a strategic weakness and what a united European approach could unlock. Please welcome Professor Philippe Tibi.
I will talk about the European LP strategy, and I will start with a simple fact, is that capital decides outcomes. You know, in Europe, we have a lot of good universities, good scientists, we have a lot of entrepreneurs, but when a company becomes successful, when a European company becomes successful, they tend to not only look for US money, but also they are US controlled. And that's a big waste for us and for our citizens as well. So that's, I think it's a fact of life, and that's exactly what we want to change. And this is why I think the spin of the conference about capital is so important. And the thing is, I think all of us are aware of that today, but the thing is, how can we make this happen? The second idea I want to push forward is that for LPs, technology should be a priority. If you look at our history, in the 19th century, Europe was leading the world. You know about the British Empire, the French Empire. How come?
The German Empire.
Because these two countries, in the first place, historically, have promoted
Is it already special, or do I have to do anything?
And as a result of that, and in defense as well and military, they could be able to exert influence in many parts of the world. Today, the clock has turned. We have turned the clock. Now Europe is in the middle of between a rock and a hard place. We are faced with two increasingly unfriendly powers, the US and China, that master technology. And they know that technology is the source of power. And what makes things even worse for us, if we do nothing, is that artificial intelligence is not only a hype. Artificial intelligence is a general purpose technology that is very similar to the first and second industrial revolution, because while the latter were the domination of mechanical force, of mechanical energy, artificial intelligence, if that works, will master collective intelligence and will bring the same kind of productivity gains that we experienced in the last century. So, and it means also that that will be shareholders of this venture will get disproportionate return. So I think that's the very reason why LPs should be invested in technology, above the fact that, of course, MSCI TMT is more than 35% of the global capital market. Are we equipped to do that? Yes, I think Europe is equipped to do that. Europe, the savings of the households in Europe are about 35 trillion, north of that probably, euros. It's more than the US, actually, in terms of savings. The issue that we have is that we have savings, we don't have capital. And what we need to find is, or to develop, is a formula to transform savings into capital. Because as we know, since the great economist of the 18th century, and even since Karl Marx, the capital is a factor of production that needs to be employed in full force. So that has been made clear by many reports, starting with the Draghi reports, with frightened everybody because he was talking about 4 trillion euros in 5 years. But again, 4 trillion, if you compare to 35, is not a big deal. I think the mistake in this report is that it promoted public money, which I think is kind of no-go for many people. But we have a lot of private money. So the question is, how are we going to action private money there? The Cookies Noyer report that was delivered in Berlin last week is a strong encouragement to do that via private money, and I will extend a little bit on that. So, what is the? How can we do that? How did we do that in France? I think in France we had public action with private money. The public action was to sponsor the idea at the highest level in the country by the President of the Republic, Emmanuel Macron, to say technology is a good thing. And then we discussed with the insurers that managed 2 trillion in France as a way to persuade them, if I may say, to invest in this asset class, which is a legitimate asset class. That has worked. They have invested so far 14 billion euros in VC and public listed in public equity tech. Together, we have created a platform of 160 funds, 80% of that being VC. One quarter of this being first time, which I think is very good because they are the new energy that has come to us. We have 10 funds managing over 1 billion, which I think is the threshold to go after the big pockets of this world. And what is very important in our mind is that 80% of the money is invested in the EU and half of that only in France. So it's a truly European venture, and that was asked for diversity reasons by the LPs themselves. And the pillar to do that are, political backing. Quite important to put the story in the mind of the people, of the decision makers. It is alignment of interest. We told the LPs that they invest for the returns, not for patriotism. Nobody has been promoted for patriotism, under my knowledge, but for the returns that the team brought. It's governance, which is shared with and which is owned by the LPs, and it's about professional execution. So how can we do that in Europe? The thing we don't want to do is to bring with the French model. I think sometimes we have a reputation in France in giving lessons and lecturing the world. So certainly not in a Nordic country I would do that. What we propose is to create a platform where the willing LPs would meet and invest in VCs that operate in the EU, in different countries that are not bound by national geographies. So we have our initiative in France. The Germans have WIN. We have started discussing with the Germans to gather maybe 20 LPs. There will be 15 LPs that operates both in Germany and France, and it's a nice way to shed light on people that do Europe technology on a bottom-up mode. And this will be, if that works, that will be an open platform for other countries to work. We believe that ecosystems should be national, or will be national in the first place for many reasons. So we were told that it will be a long speech, and I always overspend 2 minutes. So I will conclude to say that we have a lot of reports that are very good, that we need some action. I will come back to my Marxist reference. I know that this is a capitalist country with a left spin in the Nordic, and I've always, and I apologize for those who have already listened to that, but I have one rallying cry, which is LPs of all European countries unite. Thank you very much.
Chris, I wanted to bring you on, and everyone should hear why. If I start with that framing, we just heard from Professor Tibi. Tibi has been absolutely instrumental in everything that really speaks to getting pension capital, getting insurance capital, as is the case in France, into venture. You've been a bit a similar role in the UK. Can you just describe the initiative that you're taking in the UK and where you've progressed to?
Absolutely. Hi everyone, Chris Elphick from the British Private Equity Venture Capital Association. Been working on this for a number of years and a lot of inspired by the great work that Professor Tibi has done. You know, the British were not too modest to take inspiration from France on these things, as we shouldn't be. In a similar way, so as an association for private equity and venture capital funds, we've been tracking for years how, you know, basically, especially in venture, it's one consistent thing when it comes to pension fund investment, institutional investment into UK venture. It's been consistently 0 or 0.000 something every year for the last decade. And while, you know, 10 years ago, everyone thought, well, that's fine. Who cares where the money comes from? I mean, you know, the UK is the third largest venture ecosystem in the world, and, you know, it's been as high as 2/3 of the capital that our VC funds have raised has comes from overseas, which is great, right? You know, we're attracting inward investment. That's all great, isn't it? But I think, especially as we're talking about, you know, thinking around tech sovereignty, you know, and our own independence. You know, especially in the last few years, we've been thinking, okay, that probably needs to change, because not only from a commercial perspective, all the upside of these brilliant, you know, returns that our members generate are going to teachers in Canada and to US endowment funds and to LPs in the Middle East. We're not, as a nation, getting the upside of this fantastic industry. And then the other side of that is also, you know, especially at the later stages of venture, the UK, even though we have a fantastic, you know, seed Series A ecosystem in particular, at the later stages, we don't have the funds to pick up that investment and scale our companies and keep them in the UK and in Europe. You know, and I'd want personally, you know, the UK to be doing, you know, seen as a, you know, UK and Europe, you know, UK being part of the European ecosystem more and more again. That you know, that we have the scale and the ability to keep those companies in the UK and not be, you know, we've had an easy out for years, the last 10 years of, you know, seeding these amazing companies and then selling them to the US and listing them in the US, and you know, it's been nice, but that I don't think is gonna cover it much longer. So, sorry, to get to the actual point of your question. So in the UK we've had a series of reforms which has meant that the large pension schemes in the UK have agreed to put 5% of their assets into private markets, and, you know, we want a good proportion of that going to venture. At the moment, it's gone from 0% to 0.007%, I think, according to the Atomic Data European Tech Report, which is progress of a kind. But I'm hoping to see more of that money coming through this year, and I understand lots of VCs are speaking to pension funds in the UK. There are lots of problems, both regulatory and culturally, which we're trying to overcome, but I'm confident we'll start seeing more of that money coming.
Can I ask you both a question that we're all pensioners in here at some point. We all just want, in the end, a good, solid pension that can actually provide for our future. Is there any problem between, you know, is there a dichotomy? You have to, if you want returns, you have to go to the States. If you want to back Europe's future, you'll go to Europe. Is that a true statement, or is that completely false?
I don't think so. I think the LPs in France that are not very much invested in the US either, for maybe a not so wise reason, which is to say our liabilities are in euros, so we prefer to invest in euros anyway. So, I mean, in modern finance, there should not be that an issue, but that's a fact. So I think the issue is much more against generally reluctance to invest in technology at all stages than Europe. It's just they don't, you know. I think it's a vicious circle. If you don't know an asset class, you don't invest in the asset class. If you don't invest in the asset class, you don't know the asset class, and on and on. So because the asset class is small in the world, maybe 2-3% of the world, some LPs believe that it's not, it's avoidable. It's too much of a hassle for something which will not move the needle. Personally, I think it's not the best fiduciary alignment with the savers, because the theory tells them to invest in all legitimate asset classes, and VC is a legitimate asset classes that has produced the Amazon, Meta, Nvidia, and the like. You know, all the big US tech firms have been funded by VC at some point. So I don't see any asset class that can be more legitimate. And the fact that it's risky is, in my view, is not a problem, because the portfolio, there are some volatile asset classes, some that are not volatile, but the portfolio risk is reduced by diversification, which is also a 101 lesson in finance. So if you miss a legitimate asset class, you miss an opportunity to reduce the risk of the portfolio.
Really quickly, I want to ask both of you, and this is the final question we'll make it to cover here. I want to ask you, what are the steps we got to take across Europe, and what steps are being taken when it comes to getting more institutional capital into venture and tech?
You know, I think the steps, one side is institutional, driven by the EU and Capital Market Union, 28th regime, and the likes, which is very important, but that will take years. So I think we don't have the time to wait, because the geopolitical forces are not waiting, and we lose weight by the minute. So we need to be active. I think my view, that's very personal, is that we must start in countries in the first place with the ecosystem, because the ecosystem are made from people that meet with each other, but they don't only meet, they trust each other, and they report to some extent to public authorities in each country. So I think that is the ecosystem. And the ecosystem is institutions and people. I think that in every country, I would welcome that in every, and everybody here, I think, would welcome that in every country there are forces that influences the public authorities and the LPs to take a look. It's only take a look, do the homework, and work the other way around. Justify why you do not invest in venture. That's how we should be, I think, how the problem should be set. So I think that that's really a national push, especially because defense is also in the equation, and that's by definition very national. And then, or in parallel, we must bridge to get the critical mass, because Europe is a continent of a considerable wealth, a GDP that is the second in the world, and our competitors, they are continents. So Germany is not going to save the day, France is not going to save the day, the Nordics, despite all their qualities, are not going to save the day. So we need to work together and find common grounds, because you don't order people to work together. You need to find the right alignment of interest. And we must, because it's finance, and it's all about interest. And I think there is an alignment of interest, which is that the companies in all our countries will be better funded. You know, the reason why, as a French, I've been to maybe Poland 6 times in the 15 months, or Germany, or here in the Nordic, which is a privilege, is that I think that if there is better VC funding in all these countries, it will be better for the French companies, which is the purpose of the French government by definition. So that's a win-win. And that's why every country, even those without a financial ecosystem, should find a benefit in it, because it will fund their companies. So even the companies that are very late on finance, you see Romania, for instance, they have been funded by, they have very successful startups that have been funded by US funds. So their choice is, are you going to be funded by the US or by European VC? And I think the choice should be obvious today.
Chris,
yeah.
with a counter that's already 20 seconds beyond. I'll give you the last.
I endorse all of that, and I would just add, from the UK perspective, I think getting the balance right. How much carrot, how much stick do we have to sort of turbocharge it and make this happen? Because, as I said, we're coming from a standing start, or a lot of countries are, where it just hasn't happened before, so it's not going to happen overnight. So patient to an extent, but also, the need to see this happening, because at the moment, we're seeing that next wave of technology coming through, and 11 Labs and others, we're seeding them and putting the Series A in the UK, and then who steps in, putting 100 million, rounds in every couple of years. It's the big US funds who keep stepping in. So until we can, we need to just try and challenge that and make sure that doesn't happen, because at the moment, it does seem like we're not as aligned, especially in areas like defence. It is now a national strategic priority, I think, and you're seeing that in European governments, and we need to be as joined up as we can to change that.
And I would say to everyone in the audience, you're all opinion makers. We actually can move the needle if we come together to try and influence the people that are in power, both in the regulatory space, but also in our pension funds, to move towards more money for our European tech ecosystem. Venture is relearning an old lesson. Time matters more than timing. Long-term capital is being tested on patience, governance, and conviction. Christina Brink from Volvo Group Venture Capital, Daniel Capricorn from Speedinvest, and Joe Shorts from ISM Capital operate at that edge, across corporate, institutional, and evergreen capital. They'll unpack what it really takes to succeed as a long-term venture investor today. Please welcome Christina Brink, Daniel Capricorn, Joe Shorts, and moderated by myself, Andreas Munk Holm, co-founder of EUVC. I'll open with the question that we come from this very wide perspective of what can we do as a society. If we look at the allocation level, I'd love to ask, if we start with you, Joe, I'd love to ask you, how do you think and how do you vet managers across Europe in a way where you are able to allocate as consistently as you've done and with as much success?
Well, the exciting thing about Europe is that great tech companies are coming from everywhere. Literally every company in Europe has multi-unicorns now, which is great. The problem with Europe is that literally every country is creating great things. So how do you deal with that? I think our approach is to try to meet everyone. It's a lot of work. We fly to every single country, we try to meet every VC fund and understand where is the market opportunity, what's their strategy to approach that opportunity, and what's the experience of the team to execute that strategy. I think there's a three-leg stool of any private fund. Exciting market opportunity, strong strategy to approach that, to generate return, and then strong team to execute that strategy. In Europe, a lot of the VC community is quite young and new, so you can't apply the track record analysis that you can in other asset classes, right? There isn't 40 years of history. Most of the system rebooted after the financial crisis. So you've got to go to first principles and meet the people and understand what is their experience, how do they execute. And if you do that, it's the most... I think Mr. Tibi said legitimate asset class. If you look at long-term numbers, it's the highest performing major asset class in big statistics. But the dispersion of returns is high, right? When you invest in a company, you may lose your money, you may make 100x. The range of outcomes is unbelievable. So I believe diversification is the way to take the risk out of that. And so far, that's why we run large diversified portfolios for institutions, and that works very well. So every day of the week, we're making money, and every day of the week, we're losing money. But that's the nature of building business.
Coming up on almost 100 fund investments, quite significant. Yeah. Christina, you've invested as a pension fund manager before. Now you're doing so on behalf of Volvo Group. Mm-hmm. What Joe just said, does that resonate? Is that how you think about it?
Yes, I think I agree. And I think it's very different to change role as an LP, being a financial LP, looking for one type of fund investments, and now being more a strategic LP, looking for another type of investments. And our main strategy is direct investments, but we also have a small fund program. And in this fund program, we are looking for managers that in some way fits into our industry and can drive the growth and the innovation in our industry.
How does a fund investment complement your direct investments?
I see it mostly from a portfolio perspective, because the direct investments are Series A and beyond, and for the funds we can reach the true venture type of returns with seed and early A. And that type of investments are difficult for us to make as a direct investments. These companies are typically too small and too young to be able to collaborate with large customers or partners like Volvo and other in the industry. So it's a way of combining our create early interest across Volvo Group for what type of innovation that is happening across the industry.
Yeah, it's a bit of a very good looking glass into the future as well.
Yes, yes. And also the type of relationship that I had as an LP representing large institutional capital, that is different compared to today, because now we have more a continuous dialogue. We help the funds in their due diligences and their sourcing, and we can also potentially work together with the portfolio companies. So we have a much more active conversation with the funds that I invest in today.
Yeah. Daniel, representing the other end of the ecosystem, so to say, you're one of the GPs out there raising. You've done that for a long time and you've been massively successful. Tell me a bit about where you're seeing LPs that you're meeting in Europe, and not only talking about the institutionals, but also the likes of the group that we have here, family offices, wealthy individuals that are looking to invest in funds. What do you see them do well or maybe do less well when it comes to thinking about fund investments?
Interesting question, not so easy to answer. What I see them doing well is that they invest at all, right? That's the first, and it's way too little out there actually allocating in a way that the asset class is deserving for not only the LPs, the GPs, and the portfolio companies that we are investing in, but the wider economy and public. What I think most people struggle with when assessing venture as a part of their portfolio allocation is the long-term characteristics of it. It's probably the asset class with the longest insecurity of the outcome, that you have to wait for like 5-6 years to have an idea of your LP ticket. Will it do well? Will it do not so well? How will it do it after all? And then truly understanding the power law effect. Yeah. That's something that's so fundamentally not in our human, DNA and brain. We always assume things go linear, and they don't. Yeah. And in venture in particular, this is where this is most visible, and yet most difficult still to understand. So if I would wish not only the LPs but also the GPs properly understand, is the power law effect. Yeah. It's everywhere. Everything in the end is a hit-driven business. In professional sports, you only see the top 0.1% actually make it into the limelight, and all those others on the way there get hurt or are less fortunate. You don't see. In business, it's no other than in venture.
Yeah. Joe, if I can switch to you, because you're obviously also, and oftentimes you're raising from families that are investing alongside you as well, so to say, with a lot of LP commitments themselves. What are you like? I imagine that as a professional capital allocator, you might sometimes feel like you want to bang your head. We'll stick with Daniel.
As much as I understand their urge to do so, if I'd be really honest, just don't prior Series C. because the likelihood of the investment to fail is just so big.
Yeah.
I mean, we run an investment team of nearly 30 people. 30 people across 5 offices that do nothing else but sourcing, scouting, fighting for allocation, and then managing the portfolio.
Yeah.
This is 30 hopefully highly skilled people, comes also at a significant budget. Yeah. These are offices in Berlin, Munich, Paris, and London, and Vienna. Among some not the cheapest workplaces. That requires significant financial and personal effort to really build and actually run a portfolio, and yet we calculate with a 60% loss rate.
Yeah.
So if you, do probably 3 investments, you may expect 1 to work, and still you don't know if it's a massive outcome to justify the risk and the money at risk that you put in.
Yeah. Can I, if I ask the two of you, if you were to give one final piece of advice to people wanting to allocate more to venture, what would be your advice? If we start with you, Christina.
Yes, I think if you consider invest in venture, you probably have more capital available in other asset classes, and I think you will become a better investor in the other asset classes if you invest in venture, because you start to understand the tech, the pace of development, and often you can see that a venture company, early stage, quite soon ends up in your buyout portfolio. So I think you will become a better investor in general by being active in venture.
Great, beautiful.
Yeah, it always strikes me, none of us are using less technology year on year, right? It's literally in everything we do, driving your car and so on. So as a longer term trend, you must and you will invest in technology, whether it's through buyout or whatever. I think the power law point, and it ties with my earlier point, which is you must have patience, as you said, but you must diversify because it's a hits business, as you said, and diversification is the way you control for that risk. But my advice, if you haven't yet invested in venture capital, think about entering through secondaries. I mean, that's a really interesting play on Europe right now, because we've had 15 years of guys like that building amazing stuff.
And there is a lot of supply at the moment.
And there's good supply, and there's not a lot of demand. So what I mean is you can buy in as LPs are tired. So some of these families who put money in 10 years ago, they haven't had enough back. So this is an interesting moment where you can build a portfolio with kind of accelerated velocity, and then do primaries together, and they work well, which is well known in buyout, right? We do that in buyout strategies, but not enough people do that in venture.
You cannot understand European venture dynamics without understanding how public capital actually works. Michiel Schäfer, president of the European Innovation Council Board, sits at that intersection, where public funding, venture capital, and industrial scale meet. In this fireside, we'll focus on execution, how the EIC works with VCs, corporates, and institutions to turn deep tech into European scale. Please welcome Michiel Schäfer in conversation with myself, Andreas Munk Holm, co-founder of EUVC. Michiel, let's just make it clear to everyone. Talk a bit about what you've done with the EIC, how many companies you've helped fund from the early get-go, the focus on deep tech, the momentum that has gotten started, all because, honestly, of the EIC.
Well, the EIC itself is a startup. Well, we started only 6 years ago. But in 6 years, we had a difficult start, to be frank, like the ERC 20 years ago. But we have funded by now 742 companies, so it's a big size. We have about 115 trusted investors, so regular investors that co-invest with us. With a multiplier for each euro public money we put in, we get 3.5, well, we don't. Our 742 companies get 3.5 times private capital. So we also, let's say, helping the private market to deepen, to grow. And that has led, as most recently, it was also announced in Davos last week, the next step is also to develop a scale-up fund. So where basically pension funds can co-invest with us in, let's say, the more, let's say, Series B, C, scaling up startup companies.
I got to ask you this question. Why do we need a public actor to act both, of course, at the early stage? I think most people can understand that. But why at the growth stage? Why can we not solve this with private capital?
Well, there are different reasons for it. One is an often argument like a market failure. The private market has not done it. That's one argument. The second one is we are in an age of transition. We are moving from a set of technologies to another set of technologies, so the risks are substantially higher, and a public intervention helps to speed up the transition. It's not novel. I always tell people my grandfather in 1948 got Marshall aid, and that enabled his factory to move from 1920s technology to 1950s technology. So there's a history of doing that, and also what is important, that public funders have patience. My grandfather paid the loans back 17 years later. And we also in for the long term.
There are some people that use the analogy of the way that we fund early stage venture in Europe with public money and grant systems and many different schemes as a bit of a race car that's driving in sand. With that, they mean we use a lot of money, a lot of resources, but unfortunately, it does not move as quick as we would want it to. Can you comment on that critique? Can you say whether you think it's fair? And can you say, how can we overcome it?
Well, the analogy of the car and the sand is a tough one. I would remember everyone that Draghi made a report a year and a half ago, and he said we need 800 billion euros a year for all those transitions. We supply 10. So 1/80th of what is needed. So I don't think the perversion of market disruption by us is tremendously high. What I see, and that's an important element for us, is that we are able to bring in private capital joining us.
While we do have a good track record with the 1-to-3 ratio of funding to EIC-backed companies, there's another ratio that might be less nice. And that's the fact that 45% is at least the number I've seen reported, you might want to correct me on that, actually do not get VC funding to match your grants. Can you talk a bit about what's going wrong, so to say? Why is it that there are companies that are backed by the EIC that the private markets then do not go in and back?
Well, just to reverse your figure, 55% of companies do get relatively easily funding. And also another dramatic one, 10% or 15% of our companies do not get funding at all. Not private, and then also not ours. There are two reasons for it. One is that we still have a lot of European countries, not in the Northwest, but we still have a lot of European countries without a properly functioning VC system. Romania was mentioned, Portugal's also difficult, Greece is difficult, Slovenia is difficult.
And so these are countries much less when we talk about verticals.
Yeah.
Because it's one thing because we can all, I think, agree that the SaaS market in Portugal is quite well developed.
Yeah.
But when you're looking to deep tech,
it's tougher.
It's a different situation.
Yeah. So one reason is geographically. The second one is that let's say the companies have to learn how to deal with VCs. So they have also to be selective, to go to the right ones. So often it takes long because they start in the wrong way. So we also train them to do the right ones. And also because the European market is fragmented, the syndication process takes quite long. That's also why we have created this trusted investor network to make, let's say, faster connections. And maybe that's also an important term. You're also the symbol of that. We need to build a European ecosystem for startups, of financiers, of corporates that want to work with them. So that's, let's say, geographically more challenging than doing that within Göteborg or within the east of the Netherlands.
If I can make a comment, it's a politically charged one, or at least dangerous one, and I'd love to hear your take on it.
I've been a politician, so I'm used to that. Yeah.
So my comment, and I don't even know how to phrase it as a question, but my comment is that being good in tech and in tech investing is almost equal to having a strong network and knowing how to put that to work. If we transfer that to the public side, that's called nepotism. It works incredibly well when it comes to venture because we have trusted relationships that, you're in, I'm in as well. I don't even think twice. That dynamic is incredibly effective, but it's very hard to mimic and keep up with if you're running a public program. Have you ever thought about that?
Well, I think having a system that is not sensitive to nepotism is a benefit. But on the other hand, I mean, I have one experience. I was a regional minister. A company that was with us on the blacklist succeeded in the EIC. And I would have said, oh, you shouldn't have done that. So there's no interaction. That's also a benefit, that if you fail in funding at a national level, you can still go on a European level. It happens. What is also important is that sometimes you have those implicit things. For example, there was an interview week last week, and we require 3 people to come for the interview. So you come with a CEO, a CTO, and a CMO, a CFO. So basically, we foster naturally teams starting companies, also often multinational teams. So that also reduces the risk of nepotism.
Let me ask you a final question. And this is actually more of an opportunity, I would say, because I'd love for you to talk a bit about the Scale-Up Fund and the initiative and what you're trying to tackle there and the progress on that initiative.
Well, it has been launched officially already some months ago. It was, let's say, more prestige launched last week in Davos. The current situation is that we have around 3 billion euros committed. What is interesting is that we have large funds committing, and basically what they look for, mainly the Scandinavians and the Dutch, I would say, they can do their own countries. But we have a deal flow of now, since Friday, more than 800 companies. So we can offer a Swedish fund or a Danish fund or a Dutch fund a European deal flow, which is too expensive to manage as a pension fund. And that's an important reason. And it's also, let's say, if we take the elite of the elite, so let's say the 60, 70 larger companies, it's companies that are getting close to a good EBITDA and basically are moving to, a possible exit within 5 years, an IPO, if by then there's an IPO market by then, or going to private equity. So we also have now, let's say, a substantial portfolio of companies that are more industrial and more developed commercially, have a turnover of 50 to 100 million euro turnover, and basically are becoming safer investments.
Yeah. I want to give you the opportunity to say to the group here, and this is one of the reasons why I love the GoWest conference, it's incredibly strong corporate executive ecosystem that's built around GoWest. Can you just give one final statement? What would you want to say to that group in the audience, the corporate executives?
What's important that besides, let's say, the funding part, we need our startups to be able to align with larger corporations as clients, sometimes as investors, but mainly as clients, or sometimes as industrial partners to industrialize. So it's important to have those connections. We do that with so-called corporate days, but we are looking for more courage on behalf of corporates. And also, I had a wonderful visit yesterday to one of the companies here in Göteborg. It also requires of companies to be prepared to work with startups, to have a structure of doing that, to organize alignment of the top, the innovation part, and the business units. And also one of the initiatives we have announced is we are going to create a European corporate network of all the companies. We have about 90 now that have worked with our program.
EIF is often described as Europe's quiet giant, everywhere in the venture ecosystem, yet rarely fully understood. Adam Yakisira works inside that machinery at the European Investment Fund, where LP capital, policy goals, and fund economics meet. In this talk, he'll unpack why EIF exists, how it actually operates, and whether it should be seen as a catalyst, competitor, or something else entirely. Please welcome Adam Yakisira from the European Investment Fund.
If we go out here and ask entrepreneurs who their first investor was, probably they will remember. If we ask the same question to GPs, they would also like to remember. But if we turn the table and ask, but what do you think? Which kind of infrastructure you would need to ensure that you have investor when you are an entrepreneur, or you have an LP when you are a GP? Actually, through our more than 1,600 fund managers and deploying more than 50 billion over 3 decades, there was an invisible hand an invisible player that ensured that the infrastructure, that the ecosystem is there. It's being helping founders, it's helping GPs and LPs. And today, I would like to make that invisible player more visible so that at the end of this short presentation, you have a better idea of who we are and what we are. Ladies and gentlemen, proud to be here. My name is Adam, working for European Investment Fund. We are the largest investor in Europe, investing into SMEs, scale-ups, mid-caps through our financial intermediaries. How do we do that? We basically blend different sources from different channels. Of course, we have public resources. We blend those resources with private ones, and we execute that strategy through our partners. Who are our partners? Our partners are fund managers. Our partners are banks and other financial intermediaries, which help us to reach out to successful, innovative, and breakthrough SMEs. And we are proudly doing this for the past 3 decades. Obviously, when we are doing this, we don't crowd out the private capital. That's not our intention. Our intention is very clear. We aim to provide incentive for the private capital so that if there's a risk, EIF takes the first mover risk and we bring other investors in. And how do we do that? We basically assume different roles across the different stages of the market. We can be market builder, we can be market catalyst, or we can play a market access role. What does it mean? It means that depending on the need, depending on the market, depending on geography, we back first-time teams, we back emerging managers, or if there's already a tangible talent, then we help those emerging managers to break through the market. If we move up to the value chain, then we have established managers, we have blue chip managers, then we help them to shape the strategy that will be definitive for the European tech market. And obviously, this provides a pan-European geographic reach that we have today and that we are building on it to assume or to implement the key policy areas which are in line with our shareholders' objectives and the needs of the European people. And how do we do that? We do that by covering the different segments of the financing ladder. If you look on the left side, you see the technology transfer funds, which is mostly pre-seed, and it comes with, of course, higher risk, and then it goes all the way up until the pre-IPO. What we call is a financing continuum that EIF aims to build and has been building over the past 3 decades. And what is the objective? The objective is very clear. The entrepreneurs, when they are scaling, they don't fall into cliffs, funding cliffs, neither do the GPs. So that when the company scales, there is a successive funding rounds and financing rounds that is available at their will. And how did we do in terms of numbers? If you look at this illustrative graph, and this is actually based on our actual data, EIF has been catalyzer, a consistent, a counter-cyclical, because you can see that it's volatile. We have been there for the entrepreneurs, we have been there for the GPs, especially in tough times. And on average, we have leveraged 5 times the euro that we have committed. And EIF has been an anchor player, a trustworthy player, and a collaborator for the industry. And if you look, how did we do that geographically? Let's move quickly. A few dots in a few countries, and then we move on 2000, 2005, 2010, 15, 20, and 24. We see very diverse, very vibrant, and also quite lively map there. And that is not by chance. That was intentional, it was studied, it was worked, and EIF has committed to achieve the picture that we see at the end of 2024. Is it enough? Of course not. There's much to do. There's much to achieve. And this just shows our growing commitment and growing investment into European tech scene, into European markets. Let's have a look at the trajectory. So we always hear that Europe is behind the US, which is true in terms of VC investment, in terms of private capital investments. But one thing that we should keep in mind, how far Europe has come over the past 10 years. If you look, the tech value created by Europe, it was 43 billion in 2014, and to 2024, it was 426 million, 10 times more. And if you compare it with US, it's 5 times. On absolute figures, obviously, it's around 2 times, maybe more than 2 times less than US. But on relative terms, Europe has achieved 10 times more value creation, whereas US has achieved only 5 times. That's a story, I think, that needs to be spread, and that needs to be maybe considered more positively than the current vibe in the market. And I would like to show you one case study, a case study that is super important to reflect what EIF has helped. Revolut, one of the crown jewels of the European tech scene, and what you see on the graph is the evolution of Revolut's valuation, starting from seed, Series A, Series B, C, D, E, and the secondary sale that happened last year. And it evolved from 10 million to somewhere around $75 billion. What is interesting about here is that you see it was not a one fund or one funding round or one strategy. You have pre-seed seed funds, you have early stage funds, and you have scale-up funds. And Europe was benefiting from this financing continuum, and EIF backed these fund managers. But there's also one stark picture here. The stark picture, once the value creation accelerated post-Series C, there is unfortunately only one fund that was backed by EIF, which shows there's a need for scale-up financing, there's a gap for scale-up financing, and EIF is committed to fill that gap going forward. And how are we going to do that? So obviously Europe has evolved, so has EIF, and there are some key thematic areas that we see are important for the European economy, for the European people. What are those themes? Space. Technological sovereignty has been mentioned many times since morning, and it will be mentioned even more. And as such, we consider space as an important area for fund managers going forward. The second one, life sciences and health. Biotech and biotech companies and developments are driving force behind much of the value creation in Asian markets and in US markets. And as such, this will be an area that EIF would focus going forward as well. Semiconductor chips, semiconductor technologies. No surprise here as well. We see much of the geopolitical shifts and discussion today are also ramifications of these areas. Who controls these important niche segments? Industrial technologies, robotics, automation, industrial efficiency, this will be also extremely important for us. And finally, defense, which was maybe taboo for EIF up until last year. But starting from last year, we doubled down our commitment, and we will increase our most likely influence in this area as well, so that Europe regains its defense capabilities that has long been neglected. What does all this mean? This group of people, of course, you each have different interests, potentially also different questions. What EIF means for entrepreneurs is a continuous funding opportunity. At least when you scale, when you grow, the market and the ecosystem should offer you opportunities to scale your business, to continue growing, and bring the prosperity and wealth to the European continent. I'm sorry for the font. Now I realize that it's not very visible. If we move on, of course, for funds, our long-term partners, we help them and they help us. We bring stability, we bring anchor role, and we help them continue finding the best entrepreneurs, even in the tough market environments. And if we move on to other LPs, what do we do for them? This was also mentioned many times. some LPs find it difficult to enter into this asset class and sometimes allocate enough resources. So EIF's involvement in funds help them at least de-risk some of the assessment they are undertaking when investing into fund managers. And finally, for the corporate innovation institutions or corporate LPs, of course, we help them and we offer them an innovation pipeline that is strongly linked with their objectives to remain competitive in the market. We don't do drones, or we don't build spaces, and we don't code, but we at least ensure and try to ensure that people who do this have enough financing, have opportunities so that they can stay in Europe and they can become successful in Europe. Thank you.
Adam, I want to ask you one question right up in your face. EIF is an absolute behemoth. You've backed 1,600 funds. Some would say that we're becoming addicted to EIF. Is that true?
Good but provocative question. Of course, when you look at the figures, you obviously think that market is very much dependent on EIF. Actually, how we see EIF as a stitching different bits of the market. If EIF is vanished today, potentially, so if you look at what could happen, there could be two implications. The first one, for the blue chip managers, for the established managers, they would continue fundraising, they would continue investing, but the impact would be much more visible on the first-time teams, emerging thematics, as well as some underserved geographies. So EIF essentially completes the market. Would the market collapse? Of course not. But would the market be complete? Most likely not. As such, what EIF offers is diversity, is the continuation, as well as to ensure that different parts of the market is not left behind. And as such, we could consider EIF maybe more like an infrastructure player that provides the ground so that the entrepreneurs and the entire private market can scale up on it, but rather it's not an insulin that somehow prevents the entire market to function properly.
Mia, you're a partner at Superseed, one of Europe's seed funds. I'd love to ask you, from the outside as a GP looking in at EIF, how have you at Superseed thought about EIF, and how do you hear the talk of the town, so to say, when it comes to EIF?
Yeah, so I think we talked about whether securing funding from EIF is like a golden ticket, and we talked about I see it more like a hunting license, if that makes sense. So if you have institutional backing from EIF, or in our case we have British Business Bank, it kind of gets you through the door, but it won't get you the check. It kind of sends a signal to the market that you've had institutional investors looking through all your things, and you passed that test. But all the other LPs still have their own processes, their own internal politics. And so far, having BBB in our fund hasn't secured us any check. It's just gotten us through the door.
There's a counter argument on that, which is, of course, that if you don't get it, for whatever reason, it can be more difficult to then get through the door because it's the signal to private market LPs. Now, wait a second, you don't have EIF? Like, what's going on here? Or in Denmark, it would be EIF, or in the UK, it would be BBB. Have you ever considered it that way?
You see lots of funds raising without having any of the institutional LPs on board. So no. As I said, I think if you do get them on board, it can kind of open more doors for you. But those doors can be opened without them as well. It's just more work. Yeah.
Adam, can you talk a bit about how you steward that role in the ecosystem?
For us, of course, it's a big responsibility. Sometimes when we decide not to invest into funds, we always receive the question, but how am I going to explain this to other prospective LPs? For us, what matters the most, we mentioned this leverage effect, we mentioned the signaling effect. For us, what we would like to at least ensure there is a continuous and steady participation from other institutional LPs and private LPs into the asset class. Of course, EIF is trying to ensure that role, through several, rigorous investment assessment processes. But ultimately, we cannot serve the entire market. There will always be some players who who will be unfortunately rejected, but it doesn't mean that they are not good managers. No, because we assess for that particular fund, for that particular strategy, and for that particular moment. And if that moment is not right, it might have nothing to do with the fund manager. But at least we try to pass that message as nicely as possible, and we even offer our support for them to communicate with their future and prospective LPs, so that their story is not presented in a wrong way. Let's put it this way.
I'd love to ask you a bit about market distortion. I'll start with you, Mia. Having a player like EIF, which is politically motivated, so to say, meaning that you have places where you want to see capital going. As an example, deep tech is a big focus, defense and so on. Does that sometimes act as a bit of a too strong carrot for managers?
Well, I think in our case specifically with Superseed, our investment thesis is physical AI, which means that we invest in software that empowers the physical industry. So when Europe talks about sovereignty and resilience, we were either lucky or like we were kind of there already. So I think I want to be honest, if EIF came out tomorrow and said now we're only backing consumer applications, we wouldn't pivot. Like we couldn't afford to, because we're set out to build like a 15-year track record. And if you kind of blow in the wind, like with 3-year policy changes, you can't really build that track record. So I think as a fund, you kind of have to stick to your thesis if you want to build that track record.
So, Adam, let me ask you a different question, or the same question with different words, which I think might make you answer differently. I would be surprised if you have not seen managers come back with strategies you had never thought they would implement based on what they said last time they were around.
Mm-hmm. So that's a good question, and we have seen it over the past couple of years. So in 2020s, it was climate, and now we see some of those fund managers coming back with different strategy. But obviously here we are not prioritizing the policy objectives over the financial returns. Ultimately, the technology sovereignty has become the market reality, and the markets are being shaped, if not immediately, are being shaped, and in the medium and long term will be shaped by that reality, and it creates an opportunity. And it's normal for fund managers to grasp that opportunity, because even maybe today the commercial demand is not here, it will be there. This is what we have done 10, 15 years ago when European software was still underserved. EIF took bet. We invest in fund managers who became extremely successful, and we have seen many good examples of those fund managers who backed potential technology champions that Europe has basically in the house today. And as such, we obviously don't expect fund managers to become policy instruments for us. We are telling them the geopolitics and the world order is being changed, and of course Europe cannot remain spectator to that. Europe needs sovereignty in those areas that I mentioned, I will not repeat, and EIF will need competitive fund managers who are able to go and win those spaces.
And I still want to say, if you change your thesis completely from one fund to the next, you're going to be called out on that from the LPs. Like, they want to see some track record and they want to see experience in that sector. So I think, I don't know if it's good strategy.
Well, I would say I've definitely seen people put on new makeup. Thank you, everyone, for being attentive to the panel. Thank you, Mia. Thank you, Adam, for joining us. Pleasure.